You have seen the thumbnails, smiling couple on a terrace somewhere warm. We retired at 58 on $2,000 a month in paradise. And you think, hang on, maybe that's the answer. Cheaper country, lower bills, problem solved. Except moving abroad can lower your cost of living, but it cannot fix an underfunded retirement or bad spending habits. Sometimes all a cheaper country does is give your financial problems a much nicer backdrop. Today, we are cutting through 6 myths in expat retirement planning and looking at the numbers behind the dream. Geographic arbitrage can be a powerful retirement tool, but only if the underlying plan works first. Welcome back to Jetset Jeremy, your slightly sarcastic, brutally honest guide to global travel and the financial chaos nobody mentions until you are already sitting abroad wondering where your money went. Number 1. You take your spending habits with you. The assumption is that cheaper surroundings automatically produce cheaper behavior. They absolutely do not. You move somewhere exotic and your rent drops from $2,000 to $800. Brilliant. Then you upgrade to the $1,200 apartment with the pool and gym because it is still cheaper than home. You eat at nicer restaurants more often. Drinks are cheaper, massages are cheaper, taxis are cheaper, so you use all of them more. None of those decisions feels extravagant because you are comparing everything with American prices. But the retirement budget that was supposed to solve the problem quietly starts climbing again. The problem is not the cheaper country. It is that a cheaper country does not change the person making the financial decisions. A cheap postcode cannot fix spending habits you refuse to adjust. The fix is simple. Write your target budget before you move. A specific number by category. Then track it every month as if your retirement depends on it, because it actually does. Number 2. The additional costs the $1,500 a month videos leave out. You have watched the apartment tours in Chiang Mai or Medellin. The rent is real, the food prices are real. But the monthly total often leaves out the expensive bits that do not happen every month. Visa and residency costs, apostilles, translations and document fees, international medical or travel coverage, emergency flights home, trips back to see family, replacement electronics or imported items that cost far more locally than expected. That does not mean the low-cost lifestyle is fake. It means your retirement budget needs an additional expense category, as well as the usual rent, groceries and utilities. Take every irregular expense you reasonably expect over a year, divide it by 12, and add that number to the monthly budget. Suddenly the cheap retirement may still be affordable, but at least the spreadsheet is telling you the truth. And while we are talking about costs people forget, healthcare coverage belongs in the plan before you leave. EKTA offers travel insurance products, including options marketed for expats and longer stays abroad. I will come back to that briefly later. Number 3. The 2-country tax. This is the cost of maintaining connections to America while simultaneously funding a life overseas. Maybe you still have belongings in storage. Maybe you maintain US accounts, insurance, family commitments, or an annual trip home. Your tax preparation may become more complicated. Currency conversion and international banking can create additional costs. None of those obligations disappear simply because your rent abroad is cheaper. This is why a cost of living comparison based only on what you spend in the new country can be misleading. You are not necessarily replacing one financial life with another. For a while, you may be funding parts of both. So before you move, list every recurring US obligation you plan to keep and give it its own line in the retirement budget. If the plan only works when you pretend America no longer exists, the plan does not work. Number 4. Currency risk, rising costs and rules that change. This one can damage a retirement budget without you changing your lifestyle at all. Say your spending abroad is the equivalent of $1,500 a month and the exchange rate moves 15% against you. Roughly speaking, that same lifestyle can suddenly cost you more than $200 extra each month. Then there is local inflation. Rents, utilities, imported goods and services can all rise, particularly in popular international destinations. A place that looks astonishingly cheap today may be merely affordable 5 years from now. Visa rules move too. Governments change income thresholds, insurance requirements, tax incentives, and residency rules. You are living in another country on that country's terms, and those terms can change. My preference would be to build a meaningful financial buffer into the plan rather than budgeting right to the dollar. If you need every cent of your current income just to make the move work, there is very little room for currency movement, rent increases, or a change in immigration rules. Cheap is useful. Margin is safer. Number 5. Taxes and healthcare do not disappear when you leave, and the budget has to work when you are older. US citizens living abroad generally remain subject to US tax rules on worldwide income and may still have filing obligations. The foreign earned income exclusion is often misunderstood here. It applies to qualifying earned income from services performed abroad. It is not a blanket exclusion for Social Security, pensions, IRA withdrawals, or investment income. You may also have foreign tax obligations depending on where you become resident, and state tax questions can depend on your former state and whether you have officially changed domicile. This is one of those areas where professional expat tax advice is considerably cheaper than improvisation. Then there is Medicare. Original Medicare generally does not cover healthcare outside the United States, apart from narrow exceptions. The temptation for some expats is to drop Part B because they are not using it abroad. In 2026, the standard Part B premium is $202.90 per month, although higher income beneficiaries can pay more. If you later re-enroll and do not qualify for a special enrollment period, the late enrollment penalty is generally an extra 10% for each full 12-month period. You could have had Part B, but did not. That penalty usually continues for as long as you have Part B, so dropping Part B is not simply a question of saving this year's premium. It is a decision about whether you may want Medicare again later, and your retirement budget also needs to work later. The plan that feels fantastic at 62 needs to have some chance of surviving 75 or 80, when healthcare needs may be higher, mobility may be lower, and being a long flight from familiar medical care can feel very different. Run the numbers at several ages. Ask what happens if healthcare gets more expensive, if you need more help day to day, or if you decide you want to spend more time back in the United States. A quick word on EKTA here. If you need coverage abroad, EKTA is an option worth considering and comparing with other travel medical and international products. Its expat offering includes benefits such as medical treatment and hospital-related cover, depending on the policy selected. But please read the actual terms. Check age limits, trip duration, exclusions, pre-existing condition rules, territorial limits, and whether the product matches long-term residence or simply extended travel. There is a link in the description if you want to compare it for yourself. Number 6. The hidden cost of changing your mind. Some people who retire abroad eventually come home, not because the move failed, but because life changed. A health problem rears its ugly head. Family needs you home. A spouse dies. The distance becomes harder. The finances stop working. Or after several years, you simply decide you would rather be back in the United States, as fanciful as that sounds. The financial problem appears when you treat the move as completely irreversible. If you sold your home, rebuilding a housing position in the US may be expensive. You may need a car, deposits on a rental, and money to relocate again. If you dropped insurance or allowed parts of your US financial life to disappear, rebuilding them can add more friction. This is why I like the idea of a return plan. When you arrive in Narnia, rent before buying if you can. Think carefully before closing every US account. Keep enough liquidity that an unexpected move home is a choice rather than a financial emergency. Have a return to America plan before you leave. Hopefully, you never need it, but having one means you have options. Right, let us pull all this together. This video is not saying do not retire abroad. Geographic arbitrage is real. A solid retirement income can go much further in parts of Southeast Asia, Latin America and Southern Europe than it does in many American cities. What I am saying is that a cheaper country amplifies a good financial plan. It does not replace one. If the savings are thin, spending is uncontrolled, healthcare has not been planned for, and the budget came from a YouTube apartment tour rather than real all-in numbers, moving overseas may simply give the same problems a more photogenic setting. Make the plan work first, then let the destination make it better. If you found this at all useful, or at least a little thought-provoking, please hit like and subscribe to Jetset Jeremy. There is another video on screen now, or there was one just before, or it is coming up, that connects directly with this one, so click it and have a look. Right then, that is your lot. Know what you are taking with you, know what it costs all in, build some margin, and for goodness sake, do not plan retirement around the cheapest month of your first year abroad. This has been Jetset Jeremy. Stay curious, stay solvent, and look after yourselves properly. Cheers.